All right, guys, welcome back for another video. In today's video, I want to talk about how the White House has changed the definition of what a recession is, and also just talk about broad economic analysis ahead of today's Tuesday, July 26th. We have the FOMC meeting, the Federal Open Market Committee meeting tomorrow, Wednesday, July 27th, and I thought it would just be a little bit appropriate to do a broad economic analysis, primarily focused on the U.S. market, just because the FOMC is the U.S. central bank. But going back to the title of this video, so you see, leading into the FOMC meeting, the White House has just changed the official definition of what a recession is. Um, so essentially, that's giving the Fed the green light to continue their restrictive policy, um, just by, again, changing the definition of a recession. So the here from the whitehouse.gov site, while some maintain that 2 consecutive quarters of falling real GDP constitute a recession, that is neither the official definition nor the way economists evaluate the state of the business cycle. Instead, both official determinations of recessions and economists' assessment of economic activity is based on the holistic look at the data, including the labor market, consumer and business spending, industrial production, and incomes. Based on these data, it's unlikely that the decline in GDP in the first quarter of this year, even if followed by another GDP decline in the second quarter, indicates recession. So basically, they're getting ahead of the fact that the GDP is going to look bad at the next FOMC meeting, and they're saying that you can't judge a recession based off GDP alone. Well, even if you take their new definition of what the labor market, the consumer business spending, industrial production, and incomes, probably the only thing that hasn't declined there is incomes, just because of inflation, right? When you get inflation, you do get a rise in incomes. Of course, not in relation to inflation, right? It always lags behind inflation. Wages always lag inflation historically. But, you know, it's still, in real terms, incomes are declining, right? If you look at the real amount of income lost in relation to inflation, and also the labor market, jobless claims are up. Consumer sentiment and consumer spending is in the tank. You can see that by the Walmart earnings that came out yesterday, as well as industrial production being low. And then you have this article by the White House saying, at current prices, the average driver will spend $35 or less, or $70 or less per month. I mean, this is, essentially the White House is gloating about this fall in oil prices, right? I mean, it's kind of crazy, actually. I mean, could oil prices top out here and go significantly lower? Yeah, that could happen. But I don't think there's a fundamental case for that, especially in an energy crisis, right? That we're currently in, right? The price of energy is probably just going to increase. So, I mean, if you gloat at the decrease at every low in the market, that is misleading at best, and propaganda at worst. But let's dive into the economic data. So here is your spike, your 16-week change in jobless claims, and you see it's kind of getting up into this area where you typically have some type of you know uh, pretty serious emergency, whether it be the dot-com bust, Hurricane Katrina, the Great Financial Crisis, Hurricane Sandy, COVID 2022. So jobless claims are spiking. That's something the Fed would typically look at, right? Because remember, their mandates are stable, stable job market and stable prices, right? And they're 2 public-facing mandates. So you have clear breaks in that. Here's the 4-week moving average of initial jobless claims, which is just graphed in a different format, but you can basically see that, yeah. So since roughly March or April, jobless claims have changed the downtrend essentially and spiked up pretty aggressively. So that, that's something the Fed will be looking at, and, you know, something they're definitely going to keep in mind. Remember, the Fed's public mandate is to keep stable employment and a stable labor market. Now we can go over here too, and this is really the real catcher, right? Food prices have gone absolutely parabolic, right? I mean, just crazy, going all the way to these extremes that, we haven't seen in decades, really. So again, this just destroys the whole narrative that raising interest rates reduces food prices, right? The Fed claimed to be raising interest rates to reduce food prices and to reduce oil prices. Well, they've been raising rates for the last several months, and as they've been doing that, food prices have gone parabolic, and so has oil prices. Oil prices have gotten out of control, so has food. It just destroys the whole narrative, right? I mean, interest rates do reduce the price of certain assets, but ultimately not the ones that they're really politically motivated to care about, right? I mean, oil and food being the two top ones, right? If oil and food get too expensive, you have revolutions in your country. So obviously, the politicians would be concerned about it. You need to throw a little crumbs to the peasants now and then to keep them from, burning your palaces down. So I would imagine that these food prices have them extremely concerned, and but clearly the tools they've been using have no way to address the food prices. So if you're approaching a solution or a problem with a solution that doesn't work, right? It's almost insane to keep applying the incorrect solution to that problem. So just moving on, some more signs of. So here's the consumer inflation. This shows the how, again, the government changed the definition of what a recession is, and they've also year over year changed how they measure inflation. This is why it's so difficult to measure anything in the economy, right? Because the not only is the unit of measurement, the currency, losing value and changing value, right? You have no way of knowing what the supply of dollars will be in 5 years, so you have no way of knowing what the value of a dollar will be in 5 years. Put another way, a good way to illustrate this is how do you know how much you need to retire? Maybe you're a younger person. Like, how do you put a number on that, right? In order to be able to know how much you would need to retire, you would have to know how much the currency will be worth when you do retire. And if you can't say that with certainty, then it's because, there's rampant inflation and the currency is debasing, and it just makes economic calculation harder. Well, to add on to that, that the actual units, the other measurements are changing too, right? So consumer inflation, CPI, the way they measure that metric is changing. So basically, this chart is showing you that if you had measured inflation, the way they did back in the 80s, you would have CPI coming in at 17% as opposed to the 9% we have right now. So I guess the moral of the story is, if the government is unhappy with the 9% CPI readings that they're seeing today, they can always just, change the way the CPI is measured to get that CPI lower, um, and hope the market doesn't notice. So just moving on. So right here we've got, this is the Zillow Home Value Index for all homes, including single-family residences, condos, and co-ops in the United States of America. And it's graphed against, that's the red line graphed against the blue line, which is the mortgage-backed securities held on the Fed's balance sheet. And you can see here that the Fed has, you know, as the mortgage-backed securities on their balance sheet has increased, so the home value index for single-family residences has also increased dramatically, in direct correlation with that. And so, the Fed claims to be on the side of the little guy, but in their purchase of mortgage-backed securities, they've priced the average American out of homeownership. They've made homeownership a loftier and loftier goal, and basically an unrealistic goal for a lot of Americans. And so you could say, the mortgage-backed securities being piled onto the Fed's balance sheet is directly correlated with the death of the American dream, or the ability to, own a home, start a family, all that good stuff. It's really hard to believe their claims that they're on the side of the little guy when you see stuff like this. All right, and then moving on to the next slide. So here is a good chart showing that the market is really in risk off mode, right? Um, that's because, well, it makes sense if you look at what's happened in the last few months, right? But it's kind of extreme because, like, this is following the great financial crisis of '08, and the market's actually even more risk off than it is then, which is quite interesting. And with if you look at equity allocation versus cash, basically investors are sitting in cash on the sidelines, which is a conservative approach. And considering the current economic climate, it's a decent way to manage risk. But I think the takeaway from this is that, if there is some type of shift in expectations, or right, the expectations are so bearish right now that if there was some type of narrative shift or some change or some surprise in the market to the upside, things can get pretty aggressive because of how much dry powder is on the sidelines currently. Let's see. And this is just a chart showing the destruction of the bond index. So basically the bonds have sold off. They've had their worst year since the Civil War. You've got to go back all the way basically to the point in time where the US government almost faced total annihilation to find a year with worse bond performance, similar in equities. So here the bond market is liquidity is deteriorating very quickly. This is so this is what really drives the Fed pivot, right? If at the end of the day, the Fed is backstopping the U.S. bond market, and if there is issues in the bond market, kind of like in 2020, the mortgage-backed security market went no bid. That's why the Fed stepped in and slapped mortgage-backed securities on their balance sheet. If you see that happen, or some type of disruption happen, which we are seeing right now in the bond market, you can pretty with good degree of confidence predict the Fed's going to step in and provide liquidity. And let's see, this chart right here is just showing that the projections of the Fed, they rarely of running off their balance sheet rarely meet reality, right? Projection, reality, projection, reality, projection, reality, projection, reality, projection, reality, and then here's our current projection. What will reality meet that? Probably not. Reality never meets it, just because the projections are a little bit unrealistic. This chart is showing you the how inflationary spikes affect corporate earnings. So anytime you get an inflationary spike in CPI, you see these corporate earnings marked by the red line are low, basically showing you that inflation and corporate earnings have an inverse relationship. So moral of the story is that equity valuations are going to get hit during a period of inflation. It's just the nature of equities. They're valued on cash flow. So then going right here, this is the U.S. National debt. Really, the one point I want to bring people's attention to is the U.S. federal debt to GDP ratio down here. So you can see the debt to GDP in the 80s when the Fed tightened. People always invoke Paul Volcker, and where he basically was a federal chairman around the 80s, and he ratcheted the interest rates up to roughly 18%. And people credit him with taming inflation, even though we've had an incredible amount of inflation since that time. And during that time, people suggest that interest rates could get that high. Well, they can't get that high because the debt structure is different. The debt to GDP is very high right now, right? You can't taper, you can't raise interest rates that high with debt to GDP where it is currently. So, people who make that argument are just not being honest, or either they're not aware of debt to GDP, or they're not being totally honest about their assessment. Because now, you can't, you raise interest rates slightly, just the ability for the government to service the debt is severely diminished. And it kind of ties into my idea that, the ultimate path of the Federal Reserve is to try to get US debt to GDP back down to levels that are manageable. Well, how do you do that, right? You can't do that by paying off the debt. It's not really possible. But what you can do is you can inflate away the debt, and you can, get to a situation where the only way to get back to the 1980s debt to GDP is to let negative rates run for a long period of time, and then reduce the burden of the debt through inflation, and then you can get to a normalized GDP, which I believe is what the Fed would do if left to their own devices. And I think that's what they will ultimately do after this election cycle, and after the political pressures is off them a little bit. Maybe a dip in CPI. Maybe they even redefine what CPI is, and and ultimately, go back to their original goal of normalizing debt to GDP, right? And claim victory over inflation. Yeah. Anyway, hope you guys like this video. If you guys do like this content, make sure to just subscribe to the channel, leave a like on the video, and I'll catch you guys in the next upload.